Okay, so welcome back. We're into our third adjusting entry 3 and adjusting entry 4, because there are 4 types of major adjustments. Remember, the reason we're making adjustments is because of accrual accounting. And accrual accounting is the reason for adjustments. Let's actually put that up there. Accrual accounting. Accrual versus cash basis accounting. Abbreviation. Accrual, we talked about this in a previous video, but just to review. Accrual is the idea that we recognize revenues when they are earned, and we recognize expenses when they are incurred. That's different than cash basis. Under a cash basis, we recognize revenues when they are received, and we recognize expenses when they are paid. And it's because of the reality that generally accepted accounting principles is accrual basis accounting rather than cash basis accounting that these adjustments come up. That plus the idea of periodic reporting. Periodic reporting for me is just the picture, the time frame. We have a time period. Here's time period 1. Here's time period 1. Here's time period 2. And time period 3, 4, 5. There are things that happen here. Picture it just from a picture perspective. There are things that happen here that may get paid over there or may get received over here. And this helps us to push into the third of our adjusting entries, which is what? Actually, I want to use a different color pen. The third of our adjusting entries deals with accrued expenses. And then the fourth is going to look at accrued revenues. Accrued revenues. Believe it or not, this is going to be on the final exam. What is that word right there? Obviously, it's revenues. It's clear as mud. It's revenues. This is revenues. So, accrued expenses and accrued revenues. Here's a picture of what accrued expenses look like right here. We have expenses incurred in this time period, but they get paid over here. This is when the cash actually goes out. An example, that would be wages. Or accrued revenue would look like this. We've earned the revenue here, but we're not going to actually receive the revenue until over here. So let's take an example of these. Take, again, 2 sides of the same coin. And I have to make up an example here. Let's say that I own a company. Let's call it Steve's Construction Company. Steve's Construction Company. It's called SCC. Steve's Construction Company. Here's me. I'm happy. Happy guy, my hands are up. And let's say you're a homeowner, and we're building a home for you. So let's put you over here. Here's your home. There's a picture of your home. It's a beautiful home. And then here's a picture of you, and you're happy because you're having a home built. So there's you, and here's Steve's Construction Company, and I make an agreement with you that says, hey, I will build a home for you, and you agree to pay me. Let's go back to a different color pen because it's fun. Let's use this color here. And you agree to pay me my revenue. You're going to pay me. You pay Steve's Construction Company. Well, let's say you pay me $1,000 a week. $1,000 a week is what you're paying me. $1,000 per week. Okay? To build you a home. And so we have signed an agreement. You're paying me $1,000 a week. Billed weekly for you for me to build you a home. So I have a friend. His name is John. So here's John. Here's John. He's a happy guy too. This is John. And John is working for me. And I say, John, I will pay you $100 per day to work for me in building a home. And John says, okay. So we're going to keep our illustration simple here. So let's just draw a little picture over here. Here's our time period. Let's draw a time period. Let's say this time period is a month. Let's make this a month. Here's month 1. Here's month 2. But we have a week that goes like this. Monday, Tuesday, Wednesday, Thursday, Friday. Monday, Tuesday, Wednesday, Thursday, Friday. Here's month 1. Let's call this January. Here's month 2. We call this February. And we're interested in reporting at the end of January what's going on in our company. You can see here that this week is split between 1 month here and 1 month here. And so John is working, and he's working over here. And he's making $100 a day. So John earns $100 a day here on Monday. He earns $100 a day on Tuesday, $100 a day on Wednesday, $100 a day on Thursday, and $100 a day on Friday. Accrued expenses is the third of our adjusting entries. And what do we have to deal with when it comes to accrued expenses? Accrued expenses means simply this. They're costs that I incur, but they're not paid and they're not recorded. And you can see right here that I have incurred expenses to John. I have to pay him 100, 100, 100. I've incurred these expenses, but I haven't paid him because I pay him at the end of every week. So I'm going to pay him on Friday. And over here on Friday, I'm going to be paying John $500, right? For $1, $2, $3, $4, $500 worth of work. But the problem is I have to report right here. So expenses, accrued expenses, are expenses that I have incurred, okay, but they're not paid and they're not recorded. So I have to record these expenses. And the question is, what does the adjusting entry look like? I'm running out of room, so here's the adjusting entry. To record expenses to John, I have to pick up this right here. I'm interested in picking up that because generally accepted accounting principles, accrual accounting, I have to recognize expenses when they are incurred. I've incurred those expenses. So I have what? Wages expense of what? $300. Payable to John. Payable to John. Payable. Wages payable. So I have an expense of $300 and a liability of $300 that I have to record as an adjustment at the end of January to show that the expenses of $300 belong over here in this time period here, even though they're going to get paid over here in time period 2. So this is the third of 4 adjustments, and the third is accrued expenses. We're going to look at the accrued revenue side of this transaction, the other side of it, in the next video. But I just want to show in this video, here's the adjusting entry right here. And then when we actually pay the wages, the entry is going to look like this. Let's use a different color. The actual payment of the wages is going to be a credit to cash for how much? $500. That's how much we pay John. But $200, this and this, belongs in time period 2. The first $300 belongs in time period 1. The second $200 belongs in time period 2. So our wages expense for time period 2 is only going to be $200, right? That and that. Well, our assets don't equals liabilities plus owner's equity. We need another $300 right there. What is the debit to the $300? It's this here. It's this $300. That liability that we recorded here gets paid over here, and we debit the liability, wages payable. So we debit wages expense for $200, wages payable for $300, and we credit cash for $500. Can you see what this does? It puts $300 of the expense, excuse me, in time period 1 where it belongs. It puts $200 of expense in time period 2 where it belongs. And it shows an ultimate cash outlay of $500, which is actually what we're paying John. And the liability, which is showing on our books for $300 at the end of time period 1, disappears in time period B2, in time period 2, because of the $500 that we're paying to John, $200 of it is time period 2 expense, $300 of it is time period 1 expense, payable to John and being paid in time period 2. So these last two, accrued expenses and accrued revenues, are a little trickier than the first two we looked at, where we had money received in advance or money paid in advance. In this one, we're looking at accrued expenses and accrued revenues. Now, in the next video, we're going to look at accrued revenues, which is not the same exact scenario. I'm going to take the same exact scenario, but I'm not going to look at it from the perspective of us paying John. I'm going to look at it from the perspective of you paying us and our need to recognize revenue, accrued revenues. Because we have earned income. Even though you haven't paid us, we have earned income at this point in time. You're going to pay us here, but we've earned it there. So we'll look at that in the next video.